Good evening, everybody, and welcome to another live stream by the Option School, where we talk about option trading strategies, and option trading adjustments. So, today is Wednesday, and tomorrow we have a monthly expiry, and the way markets are behaving is really a difficult situation. Earlier, markets were going up only, and now the speed which market has shown in this last week. I remember last Thursday, market touched all-time high of 14,753. That was an expiry day, and today markets have touched almost 13,900, so almost 800 points fall in just 1 week, in which there was a holiday also, right? So welcome to all of you, and let's see what kind of expectations we have from expiry, which is going to happen tomorrow, and then some important talk about adjustments and what kind of trade adjustments and firefighting techniques we are going to talk in our upcoming workshop. Welcome to all of you. Thanks, Mr. Akshay. Hope you are maintaining a good atmosphere. Mr. Rajiv, Mr. Ashok Singh, for confirming that the voice is audible. So nice of you. All of you who are new to channel, please go ahead and click on that subscribe button. And when you are clicking on the subscribe button, do not forget to click on the bell icon also, so that you get a notification whenever we are doing a live stream. Most of the working days we are live at 9 p.m. And all the other members of the family, you know which button to click. We need to click that like button even before we start the video. So what Mr. AB is saying, when markets was going up, all the bad news were ignored, and now when market is going down, all the good news is ignored. That's like markets are like that. So earlier also we were talking that, okay, you do not know whether market follow news or whether news follow market. So whatever happens in the market, as an analyst, people tend to justify whatever is happening, right? And now, without any rhyme and reason, obviously one of the reasons is that markets are falling because FIs have now turned into net sellers. Today also they're sellers only. So that is a big point. And DIs are always selling positions. Maybe they are having some redemption pressures or whatever. But yes, so these are now turning out to be totally opposite markets of what we have been seeing in last 3 months. And if you see, market have already come down to the expiry levels of December, and so we are not seeing anything like 1,000 points plus every month, 1,000 points plus every month, and that may not happen in the month of January. That's is pretty clear now with today's move. Now see what has happened today. We started obviously what happened yesterday is that, okay, ultimately the overall strength was not there, although pretty much at the similar level for what we have closed the earlier day. Opening was not that bad. It was just a case of opening. After that, this was opening and both the same. It just opened at 2,995, but after that, consistently went down, and at 237, Whenever we fall, it will be really sort of fast and furious fall. So fall was also pretty fast and let me say pretty bad also, right? It's not easy to contain your trades when this kind of fall is happening. And the new method in the market seems to be that okay, if you let us rise continuously and quickly, and if it is falling, let's fall continuously and with double the speed of what was happening when markets were rising. So that way, undoubtedly tough, very tough markets. And I'm pretty much sure that okay, many of the traders must have got stuck up, because the kind of mindset all of us were trading in these markets was that okay, now till budget nothing is going to happen, and this market is going to uh, touch 15,000 and stuff like that, right? That was the expectation from most of us, right? What is happening? Not getting the voice. Is it better now or still not working? Okay, slightly better. I think something has changed. Just give me a second. Just give me a second. Let me change few things. Okay. Is it audible now? Thanks. Thanks. Is it audible? Hopefully. So if it's audible, let us move ahead. So yes, it was a big fall. 271 points net fall is really big for any kinds of markets, right? And let's see now, in these kind of markets, it's very difficult to analyze option chain and reach conclusively to some figures, because I don't know whether it's a global phenomena, and then there is a US Fed meet and there will be outcome of that. It's a news driven expiry, and then there is a big event for local markets also. So very difficult to do any meaningful analysis. So I didn't wanted to do that, but yes, I said okay, let us at least see the data and see what kind of points are available on Nifty expiry, right? So market has closed at around 967, so we can say 950 is the. Let me pick up a pen here. 950 is, we can treat 950 as straddle. So if you see straddle premium 950, it is almost 85 rupees on call side, 54 rupees on put side. So 80 plus 50, 130 plus 5 and 4, 139 rupees. So 139 rupees, let us assume 150 rupees. So on upside, 13950 plus 150 makes it 14,100, and on downside it's very scary, it makes it 13,800. So even at 13,950 on last day, we have around 130 140 rupees. So that means traders do expect that market can move here and there, which can be a substantial move. Second thing is, if you see highest open interest on call side, if you see, it is showing at 14,500, which seems to be meaningless as of now. 14,500 when market is at 13,950 is meaningless. So we need to see the second highest open interest. Second highest open interest is at 14,100. So these two things are sort of coinciding, that okay, 14,100, straddle is saying this, yes, market can go up to 14,100, straddle premium is saying that, and highest open interest is also saying that market can go to 14,100. Remember, markets do tend to touch their highest open interest. So this has happened for the whole month. We are saying 14,000 is highest open interest, 14,000 is highest open interest on put side, and today it has touched that. Not only touched that, it has breached that also, right? So 14,100 upside, it seems that okay, 14,100 can be the topmost level. Again, if there is some news, if there is some other event, then these things can be ignored. But otherwise, as of now, it seems that okay, 14,100 can be a top, plus another 22 rupees premium which traders have given at this point in time. So maybe 14,122, 14,125 can be one of the upper levels to watch for. If market touches these levels, it can be a good sort of a shorting opportunity in next week trades. Whether you should do it or not, that is something you need to decide, but always remain hedged if you're doing those kinds of things. So 14,122 should be the level which market should not cross on upside based on this data. Based on anything else, what will happen, we really need to see. But upside data is data looks like to be a good confirming data. Let's see what is happening on downside. Now on downside, again, if we see highest open interest on put is 13,500, which is, again, we have to ignore. We do not expect that market should go to 30,500. The premium available is only 2 rupees also. So next highest here, again, if you see 14,200 and 14,000 are almost similar. So now here there is a big non-confirmation. Why that non-confirmation? Because the straddle premium is saying that market can go up to 13,820 or so, but highest open interest is saying market is at around 14,000. So maybe the last 1 hour 50-60 points, or maybe almost, you can say 9, where is market closed, 967. So last 50-60 points are uh, spoiling the whole analysis, because had market been closed at around 14,020, 14,030, we could have still said that okay, we are considering 14,000 straddle premium, and maybe 14,000 is highest open interest. Then also, as of now, highest open interest is sitting slightly in the money. Now this makes it uh, slightly uncomfortable, that whether market should really go down, or whether we will see that okay, lot of new open interest getting added uh, in tomorrow's gap down or gap up opening. If you see Dow Jones, it has really gone down by almost 400 points. So as of now, any expectations of gap up do not look very right. But data definitely says that okay, lot of traders are still sitting at 14,000 put. Lot of traders are sitting at 14,000 put, although there is a little bit of unwinding at this level. Change in open interest is slightly negative, but otherwise, if you see, uh, it's almost highest open interest is 14,000. So still there is expectation in traders that okay, market can uh, come to levels which are above 14,000. This needs to be seen. This, as of now, is very non confirmative. And if you see change in open interest is highest at 13,900. And if I see change in open interest on other side, oh, it's too high. 14,100 is 50,000, which is very high. So 39 and 14,100 gives me an average of 14,000, and 14,100 and 14,000 gives me an average of 14,050. So this market should be played for a level of 14,025. Uh, as of now, it's 13,967. So those 50-60 points are not helping us to conclusively say anything on the downside, right? If I see the third parameter, let me remove the, if I see the third parameter, where is the congestion? If you see at around 14,100, it's 55,000 plus 27,000. So roughly around 55 plus 27 is 82. And if I say 14,000, it is 40. 41 plus 41, again 82. So 14,000 and 14,100 are having a similar kind of a congestion. Both the points are eligible for any kind of expiry. What about 13,900? It is roughly around 14,000 on call side and 33,000 on put side, which makes it only 47,000, right? So, which is not the right candidate for expiry levels. So, based on this data, and this data can drastically change tomorrow, we have seen on expiry day lot of change in open interest is there, right? But today people have really sold huge number of calls. If you see at all the strike prices, even at 13,900 and 13,950, lot of selling has taken place, and on put side lot of selling has taken place beyond 13,900, right? All the positions are really sold. Now all this data suggests that okay, expiry can be somewhere at 40,000 or 40,100 also, but downside is wide open for me. When these calculations are not matching, that means that side is wide open, and we need to be extremely cautious when this kind of data is there, because it shows that okay, most of the traders are quite confused that okay, what is happening in the market. Maybe this kind of a fall and this kind of a consecutive fall, we have seen a fall on Friday, Monday, Tuesday, and Wednesday also. Although Tuesday was markets were closed, but overall there was a fall in SJ. So this can catch traders a little bit unaware, and maybe all these traders who wanted to take some action are not able to take action, and tomorrow they will be pretty aggressive. In case market gives a gap down, they will be very sharp in squaring of their positions, and maybe taking their positions to 13,900 or 13,800, trying to give a sort of a bottom to the market. But again, option sellers or option buyers do not uh, direct the direction of the market. Market direction is judged by market direction is known by basically what is happening in the cash trading, right? So difficult to say if lot of buying comes, because FIs are now net sellers for last 3 days. So if there is some additional buying coming in the market, then only you can expect. Otherwise, based on option data, it looks really difficult that okay, downside is whether it is open up to 13,800, 700, or whether market will uh, give a recovery and maybe expire somewhere around 14,100, right? 14,000 and 14,100 are showing equivalent congestion. That means both are equally good points. So tomorrow morning, when we see that okay, some data is getting built up, maybe from 9:15 to 10 o'clock, and when we see that okay, most of the data is built up at a particular strike price, it can be at 14,000, it can be 13,900. From there we can have a little bit of judgment that okay, this is the level where which markets will be trying to expire closer to that. So whatever is the congestion level, you can always check that market will be somewhere plus minus 25 points from those levels. But yes, I will say stay away from this kind of expiry. No expiry trades. Expiry trades can be really dangerous, because market can give a small gap up and a small gap down, and then it can give a big gap up also. Or and it all depends upon what kind of commentary you get from Fed, and markets can based on how Dow Jones behave and how Dow Jones close today, we can have tomorrow's expiry. So tomorrow expiry more than local, it is more dependent on uh, Fed commentary. And then afterwards, this will be first 1 or 2 hours. Afterwards, it will be all local. What are the expectations from budget? Where do market operators think that okay, where is the level where most of the option buyers will lose money? So those things will come into consideration. So be very careful. And I'm not able to judge any downside in this market, but upside seems to be somewhere around 14,120 to 123, right? That will be a good strike, a good level to create any kind of bearish trades. At what level you should create bullish trades, that is really difficult to judge from this data. Maybe at 10 o'clock, it requires similar kind of analysis, from where we will get a better clarity. Okay, what Mr. Vivek Chandra is saying, 13,400 is the ballpark break-even point of FI of last 4 months. Okay, so maybe most of the selling they will try to do at around 14,000 levels, and they will not never want markets to go towards 13,400 level unless and until they have really removed their inventory, right? So Tough expiry, so be careful. uh, Downside is wide open, upside seems limited, but you never know that okay, these things can again jump. So but it's more dependent on what kind of Fed commentary we get, right? And then it will be all going towards budget. Quite possible we have a bad expiry tomorrow and then markets suddenly start showing sort of a budget rally, uh, popularly known as budget rally, and they gain 200, 300, 400 kind of points on only one trading session is left, that is the Friday trading session, and then uh, 29th, 30th is there, after the 31st is. So still there are 2 days before budget, and markets can definitely recover a lot of losses in case there are big expectations from the budget, as we have heard that okay, expectations from budgets were built high, that okay, it will be once in 100 years kind of a budget, right? So let's see what happens. So be careful. This expiry is slightly, you can say, not confirming to any of the analysis, so hence we need to be extremely careful, right? Next comes adjustments, firefighting techniques, repairing the trades. All the three things are similar. Somebody call it adjustment. We generally call it adjustment. Many of you call it firefighting techniques, and many of the Western material talk about repairing the trades. All of these things are pretty similar. Just give me a 5 seconds break. Let me have some water, and meanwhile, this is a good opportunity for all of you to click on the like buttons. We will be learning certain things in adjustments, and if you are seeing it on mobile, it's better to close the chat window for a while, click on the like button, and come back to the chat and be ready with your questions also. Just give me 5 seconds. Okay, thanks for uh, increasing the number of likes. So nice of you. Thanks. Now, whether you call it adjustment or firefighting or repairing, everything is same. Basically means that okay, you have taken the trade and it is not, the trade has not gone in your favor, and now you need to do something. So there can be trades which are limited risk, defined risk trades. There can be trades which are unlimited risk kind of trades. Especially when you are taken the trades which are unlimited risk kind of trades, it becomes very important to have some uh, right methods of adjustment with you, right? So there are some good standard methods of adjusting the trades, but I want to caution here. I do not want to, you see, over glorify these things. These adjustment methods, whatever standard adjustment methods are there, they do not guarantee that the trade will always be profitable. So any hedging, many times a lot of traders, when I talk to them, they say, okay, how come my trade has gone into loss when it was a hedge trade? Now hedge trade doesn't mean that okay, trade cannot go into loss, right? So even a hedge trade can go into loss, even an adjustment trade can go into loss. But what they guarantee is these methods, that your trade outcome will be better than the original trade because you have done some adjustment. Suppose otherwise, the trade would have given you a loss of 5,000 rupees. By doing some adjustments, some standard adjustments, some non-standard adjustments, what will happen instead of losing 5,000 rupees, if you have lost only 1,000 rupees? That outcome is better than the original trade outcome, right? It's not that okay, if the original trade was showing you will lose 5,000 rupees and now you will make a profit of 1,000 rupees. No, I'm saying if the original trade, the quadrants were such that okay, in case things go against you, you will lose 5,000 rupees. By doing adjustment, if you're losing only 1,500 rupees, that means the adjustment has given a much better outcome compared to the original trade, right? So there are good methods of creating these adjustments, but before applying these methods of adjustments, we need to see certain other things in the trades. What are those other things? Now when markets are extremely volatile, we better to have understanding of these methods in our kitty, so that whenever required we can apply these adjustments. Now before applying any repair trade and any firefighting technique, we need to understand certain things in adjustments, and This is again coming out of discussion with many of good traders. We have good traders in the sense who have good experience in trading, and I have found that okay, this point is really missing. Although we are making this point in many of our workshops also, but since a lot of things are covered in a 2 days workshop, so these things may not get too much focused, right? And adjustments can be well planned at times, and they can be sometimes done based on situation in hand. So there are no fixed watertight compartment that okay, you have to adjust this way only. Sometimes yes, there is a plan that okay, you will adjust this way, but when you find that okay, you are into a situation, there is a better adjustment available, definitely you can go for better adjustment also, right? Now, most important basic mechanism of doing these adjustments is, especially when you are into a multi-leg strategy, any strategy which has more than one leg is a multi-leg strategy, is identifying the pain point. I have seen with lot of experienced traders that many times this point gets missed, and in a eagerness to do adjustment here and there, uh, the main point is we are not able to identify the pain point. Once you do not know what is the pain point, then the right kind of adjustment cannot be done, right? Now, once pain points are identified, adjustment techniques can be applied to relieve the pain from the trade, but it cannot, it again, it's not compulsory that okay, once you have removed some pain from the trade, that okay, trade will be always profitable. It will have a much better outcome compared to what was the original trade. We must understand. So many times, why this point is coming again and again, I have seen so many people who have understood, but they are not understanding the context that okay, if I have done this adjustment, why I am not in profit. There is nothing can be guaranteed, right? If you have done the adjustment and there are two guys, one who has done the adjustment, other person has not done the adjustment, if market has reversed, maybe the person who has not done the adjustment will be better off. So whether this adjustment what you have done is going to pay you or not, but one thing is there, yes, any adjustment you do should reduce the pain from the trade. Now, most important is identifying the pain point. So let me give you some examples of some of the trades where we can identify what can be the pain point, and at times it can be different. It can be one leg, it can be two legs also. Now, if I show you an example, suppose I'm talking about a strategy, and I'm not giving you a comprehensive list, which definitely we'll be giving in our workshop. Now, let us say there is a trade which is known as short strangle or short straddle, wherein you have shorted a call and you have shorted a put. Now, pain point can be a sold call if market is moving up, and pain point can be a sold put in case market is moving down. So you cannot say that okay, when I have done a short triangle, always it is a put which is disturbing me, or always it is a call which is disturbing me. Depending upon the situation, whether market is going up or whether market is going down, you need to decide okay, what is the pain point and what can be done, which adjustment technique I can apply. Do I apply breaking the trade? Do I apply conversion? Do I apply roll up? Do I apply rollover? What adjustment technique I apply, or do I do a martingale, so that the pain point is reduced, so that my further risk is not increasing in that trade, my further risk is decreasing in that trade, right? So again, you need to identify the pain point, which is simple. In a simple strategy like short triangle, short straddle, two leg strategy, it's always easy to find out what is the pain point. Most of the traders are able to do it. Long strangle, what can be the pain point? Again, long strangle is a very simple strategy. Pain point can be a purchase call. If market is moving down, obviously you have purchased a call and market has started moving down, it is giving me a loss. That's my pain point. And it can be a purchased put in case market is moving up. So what to do with that pain point, you need to decide. Now, these two strategies are very simple strategies. I'm just showing you the pain point formula, pain point methodology, because it's very easy to understand when you're talking about a two-leg strategy. But from two-leg strategy, if we now move to, let us say, another trade, which is, let's say, ratio spread. Suppose you have created, now you can do a ratio spread, which can be a call ratio spread also, which can be a put ratio spread also, right? Now, suppose you have done a call ratio spread, and let us say we have done 1:2 ratio in call, means I have purchased one call and I have sold two calls, which is known as 1:2 ratio call spread. Now, if first thing is when will I start losing? When market really goes up and it starts touching or going beyond the sold calls. Now, in these sold calls will start giving me loss. But whether both the legs are my pain points or only one of the leg is my pain point, this we must understand. Can I get some answers? When you are doing a ratio spread, let us say you have done a call ratio spread and market is really, really going up. What what are your pain points? Is it both the sold calls are your pain point, or only one sold call is your pain point and other sold call is not at all a pain point? Because once we understand these things, what adjustment to do becomes much simpler. So can I have answers? Okay, Mr. Silva Vimal says one sold call. Mr. Bhavesh Thakkar says one sold call. Mr. Joshi says one other pair will be whole call spread, only one sold call. Great. So Mr. Rakshit, Mr. Rajiv, Mr. Bhavesh, and Rupali ma'am, all of you are giving excellent answers. So here, you need not do certain things with both the sold calls, because one sold call and one purchase call is always a profitable thing in case market is moving up. It has become a bull call spread. The problem is with the other sold call, and I need to tackle the second sold call, right? Similarly, this is again a simple trade, which is a 3 leg trade. There can be a 4 leg trade. There can be some other trade. Now, if I ask you calendar spread, let us say you have created a calendar spread, which is a call calendar spread. So there is a buying, there is a selling also. Now, which will be your painful leg in case market starts moving up? Which will be your painful leg if market starts moving up? Right? So this is something we need to see. It is not as simple as that. So it all depends upon what is happening to the implied volatility, whether I am losing too much of money in my purchase call even if market is moving up. No, it's not always sold call. It can be purchase call also, because what will happen if market has moved a little bit and implied volatility has reduced? Now this is a very plain answer. No, it will not be sold call. Your purchase call, because most of the times in calendar spread, your purchase call would be costlier than your sold call. And sometimes your sold call is not giving you that much of a loss, but your purchase call is giving you a big loss. So in these kind of trades, now when there is an event, right? So if I do a calendar spread and after that implied volatility suddenly goes down, right? Mr. Joshi says sagging should be controlled. Yes, which is a phenomena in a double calendar spread. Right, in a single calendar spread, it will not be because of sagging, it will be because of your purchase call can also give you more loss compared to what loss your sold call is. So then maybe you need to do something, that okay, I need to remove pain from the whole trade, or maybe what to do with that sold call, so that if something else is happening in the market, what to do in that purchase call, so that something else is happening in the market, still I am not losing. So again, when a strategy becomes slightly complex from a single leg strategy to a double leg strategy, it becomes a 3 leg or 4 leg strategy, then identification of pain point, and if there are multiple expiries involved, then identification of pain point becomes a pain in itself. Identification of pain point is also a pain. So these are certain things, and then similarly I can create in iron condor, in double calendar spread, in diagonal spread, in butterfly, in iron butterfly. We can have a complete list that okay, what can be the pain point if something, what 2 3 things can happen to the market. Market can stay there itself. So if market is not at all moving in long triangle, both put and call are my pain points. It all depends upon situation, what is happening in the market. Right, if market is not moving and I have created a long triangle, both become my pain point. I need to do something. Maybe I need to sell a call, a sell a put, so that I recover some money from my purchase positions. That will be the adjustment. Right, in iron condor, if market is moving towards one side, maybe the sold call is my pain point, but the purchase call is my beneficial point. So can I do something to only to my sold call, or do I need to move the whole thing? So obviously at that point in time you need to decide what is the pain point, and once we have identified the pain point, what we will do, we will do the proper adjustment. Based on our understanding, we will do the proper adjustment, and most of the times it will give us much better outcome than it would have happened otherwise. So there are different ways of reducing that pain. So it may be that okay, I'm not touching that strike price at all. As I've given you an example in long strangle, suppose I purchased a put of 13,500, I purchased a call of 14,500, and market is not moving anywhere. Both are giving me loss. It's not necessary that I do something with 13,500 and 14,500. Maybe I will add three puts of 13,000. I will add three puts of 15,000. That would reduce the pain of 13,500 and 14,500. I will create some wings for that position. So those are the methods wherein once we have identified the pain, and then we start giving some repair or some firefighting or some adjustment to the pain points, right? So this is how we try to do lot of adjustments and lot of repair trades in most of the trades in these kind of volatile markets. If you say that okay, I want to trade markets but I do not want to do any adjustments, I think it's better not to trade these kind of markets. Let markets become normal, stable, then only do trades. Because if you are trading markets without any adjustment techniques, then it's like driving a car without a steering. So you have to steer your positions. You have to sometimes do adjustments for buying time. Sometimes you have to do adjustments for buying space. Sometimes you have to do adjustments to buy both the things, right? And many times we have seen a small adjustment in the trade has worked wonderfully well, and you are able to buy. Now, like many of the traders were sitting at 14,000 put. Now today market has closed at 14,967. And if tomorrow market is open at 13,900 or try to close at 13,900, it is not at all advisable for that trader to book loss of that 14,000. So at this point his pain is that sold put. He has to do something. Maybe he can convert that 14,000 put into 13,300 put of 4th February and take all the money, and you never know, in next 2 days market go up and all the pain is removed. So what he has done now in this case, he has purchased space. He has taken some time from the market. He has shifted his trade from 28th to 4th. In the process, he has got 700 points distance. In the process, he has got 7 more days to relieve the pain. Right. So these kind of techniques are what we are going to discuss in our workshop, which is happening on adjustments on firefighting, which is happening on 30th of January, 5 p.m. to 7:30 p.m. We were getting a lot of questions that okay, what exactly you are going to discuss. So we will be discussing that okay, in different strategies, what are the pain points. We'll be giving you some examples also that okay, this is the pain point, this is the pain point, this is the pain point. And then if we have, let us say, few standard methods, how to apply those standard methods on those uh, pain points, right? So basically we are trying to give you a framework which can be used on any trade, rather than saying that okay, this should be the way for short triangle, this should be the way for short straddle, this should be the way for butterfly. We are trying to give you a broad framework which you can apply on any technique. But if you understand that okay, what is the pain point, and pain point depends upon what is happening in the market after you have taken the trade. So all of you who wish to join, already many of you have already enrolled, so all of you who wish to join to see this detail now, do not expect that okay, we'll be talking about all the strategies and giving you adjustment techniques of all the strategies. As I said, we are trying to give you a framework which you can use for any of your trades, whether it's a strategy trade, whether it's a non-strategy trade, whether it's a casual trade and you get stuck up. In a casual trade also means that okay, you have just purchased a call thinking market will go up, but market instead of going up has gone down. So is there any methodology that okay, you can reduce the loss? It may not be that okay, that there are methods that okay, even a dead person can be made alive. No, dead person cannot be made alive. If there is some life available in the patient, only then doctors can do something, right? And fighting techniques also means that okay, you are fighting the fire so that the damage is reduced. You have, if you have fought with the fire, that doesn't mean that okay, whatever damage the fire has done, that is not there. That definitely will be there. So I want it to be very very clear, right? So we will be talking about some good adjustment techniques, and we'll be seeing some examples that how to apply those frameworks with some back testing also on 30th of January. And then we have a 2 days workshop, 6th and 7th Feb. and we have a calendar spread and double calendar spread workshop on 30th of Feb. Hopefully, I do expect that by 13th of Feb, the volatility will reduce in the markets. The major budget event will be out of our way, and once volatility reduces, then calendar spread, double calendar spreads are great trades at a reduced volatility. So that is why we have fixed the date for calendar and double calendar spread for 13th of February, right? Anybody willing to join, you can contact us on these numbers. You can write to us at info@theoptionschool.in if you want some more information, right? And what about likes? Thanks to all of you. We are just few likes short of that number of 100. Hopefully, somebody can really help us to achieve that number. Share this video to somebody whom you think it will be useful, and write your comments, suggestions, ideas. Day for yesterday, we have you have given a lot of levels. Somebody has said 14,300, somebody said 14,500 levels for expiry, and now maybe all these levels might have changed with whatever has happened in the markets today. So I would request in the comment section, if you give what is the level you expect that okay market will expire today. It's I'm not saying it's uh, any reasoning, any logical. Sometimes you see you may have some reason, sometimes you may have a gut feeling that okay this is the level. So write it in the comment section. If you are able to write some I think Mr. Rajiv Agarwal has given good logical reasoning in the previous comments. We will definitely show that, and if you can write it today also, it will be very important that okay what is the level of expiry you expect tomorrow, and if there is any reason for that, please share that also. And please go ahead and subscribe to the channel if you have not subscribed to this channel and you want to discuss things about options trading. uh, it will be a good idea to subscribe to this channel. And then if you are subscribing, please do not forget to click on the bell icon also, so that you always get a notification whenever we are live. So tomorrow, keep it as safe, as simple as possible, because another hurdle is you are having a budget. During budgets, markets can really go haywire. And secondly, when expectations are raised like anything, it may end up as a very dull event, or it may become a very volatile event. It may have a big move in the market. So the problem with tomorrow's expiry trades are that okay, if they do not work well, it will become very difficult to roll over those trades to 4th Feb at least. So in case that happens and you need to roll over some of the trades, I will suggest reduce the trades. Instead of rolling them to 4th Feb, roll over them to 25th Feb or even 25th March, and take huge space from the market, right? Suppose you are stuck up in 14,000 put. Instead of shifting this 14,000 foot to 13,400 of 4th Feb, shift it to maybe 12,500 of 25th March. That will be better. Later on, once the budget is over, we can again bring those positions to the current week or current month. That would be better. So it's better to buy a lot of space and a lot of distance from the markets, because obviously budget is a big good event. Ultimately, whether it will make the markets very volatile or not, that is anybody's guess, right? But again, it's always better to be cautious, right? So take care of your trades. Wish you all the best, and see you all tomorrow at same time 9 p.m. Thank you. Good night.